Okay, what's really good, people? Welcome back to the channel. It's Tuesday. I'm on the Trading 212 site. It can only mean one thing: Trading 21 Tuesday. Apologies, I know I haven't been doing these updates for the past few weeks, but there has been some other updates on the channel, from the stake review, the genuine impact review, and obviously the free trade portfolio update. So I felt now would be a good time just to give you a reminder of the Trading 212 portfolio. But more importantly, there was two things I wanted to talk to you about today. The first is having a strategy, and the second is how to find stocks. Listen, I know they're big, encompassing topics and titles, and essentially what we're all trying to do within the market, but I think there's a really simple way to look at the stock market when it pertains to what investments you guys are going to make. So I'm going to cover my very simple process that I go through today, and hopefully some of you guys might find some value in that. So if you want to know all of that plus more, please like, comment, subscribe. Bottom right hand corner, subscribe to the channel if you're new. Also click that join button, become an Infinite Investors board member, and you'll get loads of benefits from stock picks, see my trades, see my performance 24/7. You get a private community, you get other benefits like stock checklists, spreadsheets, and a lot more value added services to come. So yeah, definitely join the channel, support the channel, and we'll see you on the other side. So let's first do a quick portfolio update so you guys can see how my pies have basically been performing, how my investments have been performing on Trading 212, and then we're going to go to the two important topics that I really wanted to talk to you about today and share with you in this video. So as you can see here, let me go back to the investments, start with the investments tab. So on the investment tab, you can basically obviously see all of my current stock holdings at the moment. These stocks are in the pies, as I've always mentioned to you, apart from Lemonade. Lemonade is the only one that I did some additional separate investments to outside of the pies, just because I had some spare money and I wanted to obviously invest in Lemonade. So yeah, that's the reason why I did that. But yeah, currently the portfolio is doing well. As you can see, everything is currently in the green. But you know, let's look at it into context of the pies, because I think that's the more important way to basically look at it. So, you know, we'll start with the kiddies pie at the bottom. You can basically see here, it tells you now that I'm 0.25% away from my goal. We're going to talk a bit about goals later on in this video. You can see that my return is 7.38%. And then if we're looking at the holdings, we can see that the best performing one at the moment is Target. So Target is 19% up. Walmart is the second best, 11% up. Then it's Microsoft at 5%, and then it's basically Apple and Visa at 1% a piece. So yeah, this portfolio is doing well. This is £100 a month portfolio. However, I did add a bit more money the last couple of weeks actually. So that's the reason why the balance has gone up a bit higher, because I haven't had this pie for 5 months. So yeah, this is doing well. I'm very happy. As you guys know, this is an 18-year pie for me. That's the goal, that's the horizon for this, and the goal for this is that in 18 years time I can give it to my unborn children, and they can obviously, you know, hopefully invest it, start a business, buy a house, do something proper with it. And if they try to do something dumb or just give it to some dumb gal or something that they linked up with, then, do you know what I mean, they just might have to just get written off in it. Just might have to just divorce the youth then. You feel me? That's how we do it over these sides. Anyway, let's move on to the next one. DPMO, development of premium monetary opportunities. I'm 0.19% away from my goal. This is a 10-year pie for those of you that don't remember. So I'm intending to have this for 10 years, and the whole purpose of this one was to have what I call premium monetary opportunities. So, you know, stocks that are going to be a lot more high risk but potentially a high return in 10 years. You know, I'm looking at hopefully a 10x return on each of these stocks in obviously a 10-year period. And you can basically see that from this tab here, where it talks about the fact that I will be investing over this 10-year period only £12,000, and you know, my expectation at the moment is £377,000 as a return. Now it was 400,000, so the return has slightly dipped, but this obviously fluctuates because it's calculated it on the accumulative 5 years performance that, you know, preceded this current moment. So that's always going to be a running figure, but you know, to invest 12 to get 377, I'm not complaining. So it doesn't matter if it's 377, 350, as long as it stays above 3, I think I'll be, kind of happy with that. Or I might have to start, changing the holdings. Anyway, if you want to have a look at these holdings, you can see the percentages are slightly higher because these are more high risk, high reward stocks than the ones in the kiddies pie. The kiddies pie, I wanted to have a lot more safer, sturdier stocks because I didn't want to kind of speculate on my unborn kids' money. But with this pie, I'm happy to speculate a bit more, and obviously they look like so far so good that they're paying off, but who knows what's going to happen in the future. So we've got Lemonade here, that's at 21% return. We've got Virgin Galactic, 17% return. We've got Neo at the top, 42% return. But now in number one position, we've got Cloudflare with a 51% return, because Cloudflare over the past couple of weeks, I mean, yesterday's performance of Cloudflare was absolutely ridiculous. We talked a bit about Cloudflare on Saturday within the free trade portfolio update, just because Cloudflare was the top mover for the week. So the previous week it was a top mover. This week is most certainly going to be the top mover again. So, spoiler alert, Cloudflare is definitely going to be the talked about thing at the end of this week. I can't see any other stock beating it, to be honest. And yeah, that's the reason why, that's been doing so well. So yeah, this pie is doing well. Overall 33% return on this pie. My investment in this one again is another £100, but I have again had some spare money, which is the reason why I've added a bit more to this as well. So I can't remember how much I've invested in this, maybe about 300, maybe something like that, maybe more. I can't actually remember, to be honest. Probably more, to be fair, because I don't really count. I just kind of put it in and just spread it across. I see these pies as basically my own ETFs, my own exchange traded funds that I'm basically creating. So I'm going to talk a bit more about that actually a little bit later on in this video. But yeah, this is doing well, and we shall see how this basically continues in the future. But yeah, 33% up on that. And then we've got the 30 fund here at the top. This was a £300 a month pie, but this was only for 3 years. So this one is a bit more money, but I wanted it only for a 3-year period to try and get a good sum of amount that I could then potentially reinvest and use that elsewhere. So invest in 10k, but to get a 30k return. So obviously, because of the time effect of money has a very big time effect, for those of you that don't know, and generally over a longer period of time, money typically becomes worth more if you obviously invest it. So the fact that I'm investing 10k for a 30k return in this pie, whereas in the other pie I'm investing 10k for a 300k return, the actual difference in the factor is less actually the stocks. It's a little bit the stocks, that is a big part to play, but the bigger part to play is the time. One of them is basically an extra 6 years, or 7 years, and the other one is obviously just a 3 years. And obviously time has a big part to play when it comes to the stock market. So the longer you're investing, the less risk typically and the more return you can typically expect to receive. In any case, these stocks are stocks that I think are going to definitely do well in the next 3 years. But they might not do well in longer periods than that. And these stocks I would have to review on a 3-yearly basis. I think most of these stocks would do well beyond 3 years, to be honest. But some of these stocks might not do well beyond 3 years. Who knows what's going to come out in the future. So you got Etsy, that's up 25%. The Trade Desk up 40%. Square up 26%. Adobe up 8%. Nvidia up 12%. Fastly doing extremely well, fastening up itself up 54%, Taiwan Semiconductor up 13%, Tesla up 4%, and Amazon up 7%. Listen, all of these stocks that are in this pie, nothing is here by accident. So if they're in the red or if they're in the green, I take full accountability and ownership for it, because these are stocks that I research. And when things are in the red, you guys have heard me on many portfolio updates that maybe my investment strategy was wrong, or I made a bad choice for XYZ reasons, or it's just not the right economy or market for me, or what, I didn't realize this, etc. But I've researched into all of these companies enough to know that I'm happy for its inclusion within this pie. And yeah, overall this pie is up 19%. So yeah, currently these pies are doing well. Obviously the DPMO pie is doing the most at the current moment. And now that I've actually maximized my ISA allowance, I'm going to be adding a lot more to these pies. So it was meant to be £500 a month across all of these pies, but that's definitely going to increase. How much so, I don't know. But we'll see. when I add more money and when I invest and when I change things, I will obviously keep you guys informed. Overall, that means my portfolio is sitting at 15.57%. And the reason why it's kind of dragged a bit down, you can see the average of these would be much higher than 15%. But the reason why it's kind of dragged a little bit down is because the additional investment in Lemonade, which is sitting at 3.77%. So that's different to the Lemonade that you can basically see in the pie here, which is obviously sitting at 21%. So that's the way that Trading 212 kind of segment it for you, and just to make sure it's clean. I would actually prefer that all of these stocks weren't even visible in this tab, but you can only see the Lemonade. But hey, maybe that's something they might do at some stage in the future. But yeah, that's my pies at the moment, all in the green, all happy days. And obviously this is like, the way I see these pies are basically my own funds, my own ETFs, are ones I'm going to basically be funding and adding to on a monthly basis long into the future. Now, the two things I wanted to talk to you about is strategy and research. I'm getting a lot of messages recently, and listen, big up to all of you lot, sending me these messages. I actually very much welcome these messages, and obviously the moment I have the time to respond, I respond to the best of my ability and try and give you the information that, I feel is definitely going to be beneficial for you. The trend I am seeing is people asking me, what do you think of this stock? This is probably arguably the most frequent question that I get from you guys is ticker symbol, blah, 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 stock name, blah, blah, blah. What's your opinion on this? Is this a good buy? Shall I buy this? Shall I invest? Blah, blah, blah. Now, some of you guys are new, so obviously you haven't seen the videos where I've mentioned that I don't give financial advice. Coming from someone that's worked in banking and financial services for a number of years, I know what it means to actually give financial advice. And there's two components to advice. The first component is understanding the person you're advising. Then the second component is understanding the products that you're therefore then going to advise. I can't advise you what to do if I don't know you and your financial situation. If you really wanted advice, I would actually have to have an hour phone call with you, understand everything about you, and then I could tell you, whether something's going to be good for you. And as I've mentioned on multiple occasions, Adobe Systems, you can see on your screen here, for John, it might be a good investment. For Sarah, it might be a terrible investment, because they have different goals, different ambitions. They're at different stages of their life. So rather than me tell you my opinion on a stock for you to then make a decision of that, what I rather would do is actually give you the tools that you need to evaluate that for yourself. So you don't need to ask me or anyone else like me. You can just ask yourself, and actually you'll get the exact same answer. And the thing that I think will help you understand is there's 5 key things that I think you guys should think about when you're trying to define your strategy. And when you define your strategy, these 5 key things, you will then hopefully find it much easier to research and find stocks that's then gonna basically sit within that. So the first thing is your goal. And what I mean by that is, what do you need the money for? Like I've showed you with these pies, and these are a prime example. With the kiddies pie, I need the money for my unborn children. So because of that, there's things that come to mind. My risk is less. My horizon is a lot longer. The type of stocks that I want to choose, I want them to pay dividends so that money can compound and reinvest over a greater period of time. With the DPMO pie, I just want to have a lot of money that I can then invest into something else. Maybe I want to start a business. I don't know where I'm going to be in 10 years time. Maybe I'm going to buy property. Maybe I'll just use it for my retirement. Who knows? But I just want to try and see how can I make the most amount of money with the smallest amount of investment. And with the 30 fund, I actually want to try and make as much money as I possibly can in a shorter period of time, and then re-strategize and basically do that again. So I have that goal in mind in terms of what do you need the money for and when do you need it by. This is the reason why they all have different terms: 10 years, 18 years, 10 years, and 3 years. They have different terms for a specific purpose and a specific goal. And this is why I think this Trading 212 feature is so incredibly important and so incredibly great at what it's actually doing, because it helps you formulate some of those questions within your mind. The first thing is goal. The second thing is amount. How much can you invest? So as I've mentioned to you in this, I'm investing £100 into kiddies, £100 into DPMO, £300 into the 30 fund. You need to understand how much you can invest, and then goes into the third thing, how frequently you can invest. Now, in these pies, I'm obviously investing on a monthly basis, whereas I have other stocks that I just bought a lump sum and I just left it. Look at the stock, look at my investments in Amazon within my free trade ISA. Look at, my investments in Tesla as an example. Look at my investments within Okta and AMD and multiple others, where I'm not trying to dollar cost average or buy on a monthly basis. I'm just trying to put a lump sum in and just basically leave it. So you need to understand how frequently you're going to expect to basically invest. The fourth thing you need to understand is your risk levels. How much risk are you willing to take? Do you really want to make sure that you don't lose a penny of this money, and it just has to be absolutely protected, and make sure that you 100% make some profit? Then you want to obviously have more lower risk investments. And that's how I feel about the kiddies pie. And that's the reason that in the kiddies pie, you can see some of these holdings. I expect these companies to be here in 18 years time. We're going to have a very different world, a very different outlook in 18 years time. But Apple has been around since 1980. Microsoft has been around since roughly the same time. Visa, God knows when. Walmart, Target, these companies have been around for a very long time. I can't see them just disappearing in 18 years time. Maybe they might merge, get acquired, but then I might benefit from that anyway. In any case, the whole purpose is that these are companies that I don't see folding within the next 5 years. Whereas with some of these stocks, Virgin Galactic might come to an end. There might be in 5 years time a big scandal, something might happen, someone might realize it's not working. There could be some, catastrophes or whatnot, and Virgin Galactic might, for whatever reason, not be there. Cloudflare, again, might be swallowed up by competition. There might be other CDN providers, other network providers that then basically, take Cloudflare. Neo may no longer be there through some scandals, or again, through the EV market becoming so saturated, or Tesla basically taking over China. So there's a lot more risk with these types of stocks, whereas with these types of stocks, I see them as less risk. So I guess essentially the point for me here is understanding what risk level you're willing to take will again help further categorize the type of stocks you should basically be focusing on. The last thing and the fifth thing is return. Effectively looking at how much return are you expecting to receive. Now, obviously, that's an incredibly difficult thing to try and understand, because no one can predict the future. No one can basically say, I want to get this amount. But what you can do, and what the whole part of this Trading 212 pie does, is basically it looks at the last 5 years historical performance, and then it basically tells you a projected rate that this pie is basically going to do off the back of that. And I can't actually see it here. I can see it on the app clearly that it would give you a percentage. Maybe it is. Anyway, you guys probably know. It's definitely in the app. Yeah, based on here, where it says estimated based on 21.11% annual return. So that annual return is an estimation based off the previous 5 years performance. So you can then sort of start to get a flavor by looking at the fundamentals of a company, by looking at how much revenue, how much earnings are basically growing on a quarter by quarter, on a year by year basis. If they were to potentially continue that trend, this is the potential return I might be expecting. So those 5 things: your goal, the amount, the frequency, the risk, the return, for me personally helps formulate your strategy. And that could be a strategy for your entire investment career. That could be your strategy for one application that you use, free trade or trading 212. That could be your strategy for one stock. That could be a strategy for one pie. Like I've said, I've got different strategies for different pies, so I don't have just one strategy. I don't believe in just only trying to do one thing. I believe in having different goals and trying to find the right strategy for that specific goal. So I think once you look at it in that way, then your next task, which is the difficult thing, is to effectively research and find stocks. But I think it becomes a lot more easier that you can then filter out all of the noise and actually just focus on the stocks that potentially fit your strategy. So when you want stocks that actually are a little less risky, you can start to look at characteristics of less risky stocks. What characteristics potentially come to mind? How long has the company been operating for? Does the company pay a dividend? Is that dividend stable? Has that dividend been growing over a long period of time? Is it a very liquid company? What's What's the market cap of that company? Is it a big size? Is it in the major indexes? These are the types of things you can potentially be asking yourself when it comes to, look, I want a very sort of low risk stock, and this is the type of thing I'm looking for. Or if potentially maybe it's ETFs, I don't want to ignore the ETF investors out there. You know, risk is a very big part of ETFs, and when you actually are looking at different mutual funds, different index funds, different ETFs, you've got basically the risk matrix right there in front of you. It's typically got a number between 1 to 7, and it tells you how high risk this potential fund is. And obviously the lower the number means the lower the risk. And so you can actually then kind of say, you know what, I'm only going to look at funds that have a risk profile of the number 1 to 3, and that's going to potentially help you make your call in that way. And whether it's risk that you're looking at or whatever the other, you know, factors of a stock you're potentially looking at, this for me is the most important thing. And this is the reason why, you know, I don't just try and give in and just give you an answer. The easiest thing for me to say is, yeah, that's a good stock, go buy it, and just move on, just because, you know, I get too many DMs. The harder thing for me to do, which is disappointing for some of you guys, but is the better thing, is to basically say, look, unfortunately, I can't give you that answer of whether it's a good stock. You need to look at these factors. What is your goal? What is your horizon? What is the amount you want to invest? What's the frequency? What's the risk? What's the return? When do you need the money? You know, how much are you going to add to, you know, your investment portfolio? And then obviously you can basically work that information out, and once you've done that, you could then start to whittle down stocks that are going to be more applicable to you. Hopefully you found this information helpful. If you want a lot more help and a lot more support on picking your stocks, identifying your stocks, talking about stocks, then definitely join the membership group. And not just myself, but there'll be other people that will be there to obviously support you. So yeah, hit that join button, and obviously, you know, I'll see you on that side, and we can talk more in detail if you did want that extra support. But listen, hopefully you found this video useful. If you did, hit that like button, get in the comments, let me know what criteria you basically look for when you're actually assessing what stocks to potentially buy, and I will catch you next time with another investment video. I just got a notification from eToro basically saying that Apple shares plunge 3%, which I'm assuming is because the people aren't happy with the Apple event that's basically just happened right now, which is one of the reasons why I didn't watch it, because I watched the special event last time and I was very, very disappointed. So I thought, I'm not waiting around to go watch the Apple event. I'll just get a TechCrunch, you know, shorter synopsis on it. But looks like people aren't going to be well receiving it at this current moment. Anyway, I'll talk a bit more about that another time. Other than that, take care, have a good evening, and I will catch you next time with another investment video. Peace.